Module Overview. By the end of this module, you will be able to understand the purpose and structure of the balance sheet, identify and explain the components of assets, liabilities, and equity, apply the accounting equation to interpret the balance sheet, distinguish between current and non-current accounts, analyze a company's solvency and liquidity using balance sheet information. What is a balance sheet? The balance sheet, also known as the Statement of Financial Position, provides a snapshot of a company's financial position at a specific point in time. It details what the business owns, assets, what it owes, liabilities, and what remains for owners, equity. Purpose: to assess the organization's solvency, liquidity, and capital structure. The accounting equation. The balance sheet is governed by the fundamental accounting equation. Assets, liabilities, plus owner's equity text BF assets, as don text BF liabilities, pass text BF owner's equity. This equation must always balance, meaning every resource the company controls, assets, is either funded by borrowing, liabilities, or by owner contributions, equity. Components of the balance sheet. The balance sheet is typically divided into three sections. A. Assets. Resources owned by the business. 1. Current assets, convertible to cash within 1 year. Cash and cash equivalents. Accounts receivable inventory, prepaid expenses, short-term investments. 2. Non-current assets, long-term use, not easily liquidated. Property, plant and equipment, PP&E. Long-term investments, intangible assets, e.g. patents, goodwill, deferred tax assets. B. Liabilities, obligations or debts owed to third parties. 1. Current liabilities, due within 1 year, accounts payable, short-term loans, wages payable, taxes payable. 2. Non-current liabilities, long-term loans, bonds payable, pension liabilities, deferred tax liabilities. C. Owner's equity, the residual interest in the assets after deducting liabilities. Share capital, common and preferred. Retained earnings, additional paid-in capital, reserves, treasury stock, deducted from equity. Key balance sheet classifications. We will be using classification, definition, and examples in our table in this course. 1. Current asset used or converted to cash within 12 months. Cash, inventory, receivables. Non-current asset held for long-term use. Land, buildings, equipment. 2. Current liability, settled within 12 months. Payables, short-term debt. 3. Non-current liability obligations beyond 1 year. Loans, bonds payable. Illustrative example, XYZ Motors balance sheet. As of December 31st, 2024. In this course, we will be using assets and amount N in our table for today. 1. Cash and cash equivalents 3,000. 2. Accounts receivable total 500,000. 3. Inventory 4,500,000. 4. Property and equipment 10,000. 4. Total assets 20,000. We will use liabilities and equity in our table. 1. Amount N. 2. Accounts payable 2,000. 3. Bank loan due in 2 years 5,000. 4. Share capital 7,000. 5. Retained earnings 6,000. 6. Total liabilities and equity 20,000. 7. Note that assets, quotient liabilities, plus equity, N 20,000, base N 7,000, plus N 13,000. Why the balance sheet matters. Liquidity analysis. Can the business meet its short-term obligations? Ratio, current assets, current. Liabilities, I text, current ratio. JAFRAC, R text, current assets. Text, current liabilities. Solvency and leverage. Can the company meet long-term obligations? Ratio. Debt to equity ratio. Total liabilities. Equity, a text, debt to equity ratio. JAFRAC, R text, total liabilities. R text, equity, asset efficiency. How well are assets being used? Helps assess capital intensity or investment needs. Limitations of the balance sheet. Historical cost. Assets may not reflect current market values. Intangibles. Valuable resources like brand strength may be excluded. Snapshot view. It shows only a single point in time, not trends. Summary of key takeaways. The balance sheet reveals what the business owns and owes. The accounting equation ensures balance and transparency. Assets, liabilities, and equity must be clearly classified. Financial ratios derived from the balance sheet provide deep insights into liquidity, leverage, and financial health. Interpreting the balance sheet helps stakeholders evaluate risk, stability, and operational sustainability.